Bitcoin has performed 3x that or more. So Bitcoin is simply the strongest capital asset, and because Bitcoin's been returning like 39% on average over the last 5.5 years.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
This is where Saylor introduces Bitcoin as a completely different type of capital asset. He argues that Bitcoin has dramatically outperformed virtually every traditional asset class over the last several years. While real estate may return 6% and equities perhaps 10 to 12%, Saylor says Bitcoin has averaged close to 39% annual returns over approximately 5.5 years. Because of this extraordinary performance, Bitcoin creates something unique. It allows financial institutions to build high-yield credit products while still maintaining large safety margins. In simple terms, if Bitcoin appreciates 39% annually, a company could theoretically offer an 11% yield product while still leaving substantial upside for equity holders. That changes the economics of credit entirely. Saylor believes Bitcoin is the highest-powered capital asset ever created. And because credit products inherit characteristics from their underlying collateral, Bitcoin-backed credit can potentially become the most powerful form of credit in the world.
I sell a credit instrument and I invest the proceeds in a capital investment that I hold for the long term. The capital investors hold the investment for a decade, and the credit investors want immediate stability, immediate yield. So if you look at the long-term performance of real estate, it's like 6%. So if I invested at 6%, I can't really pay more than 3 or 4% and still leave a margin for the equity investor. So asset-backed credit on real estate, might be a 3 or 4% dividend yielder, and of course, mortgage-backed securities and things like that oftentimes are a 3-4%.
So it does exist, yeah.
Asset-backed credit on an equity portfolio would be impossible for a publicly traded company to create because of the Investment Company Act of 1940. It limits public companies from investing more than 40% of their treasuries in securities. But theoretically, you could create it as a private fund, and private structured funds that do this, they're investing in something that appreciates, say, 12%. They could pay 6 or 7 or something. And the same is true with gold. Bitcoin has performed 3x that or more. So Bitcoin is simply the strongest capital asset, and because Bitcoin's been returning like 39% on average over the last 5.5 years. If you decided to issue a dividend, which was 1/3 of the capital appreciation rate, then there's a large margin of error. There's a big fat premium for the equity investors, and yet the credit is still much more compelling than any other form of credit. So the secret to STRC is we create a credit instrument that's backed by a highly liquid, high-performance capital instrument. And because Bitcoin is high performance, and by the way, the high volatility of Bitcoin creates high performance, and that creates high liquidity, and that passes through to create a high-performance, high-liquidity credit instrument. The credit inherits the liquidity and the performance of the capital. And, it makes logical sense that the highest powered capital will create the highest powered credit. And of course, the highest powered credit will create the highest powered money. If you then take that, you create that stable coin or the zero vol thing off of it. And low powered capital, non-volatile real estate will be, low liquidity will create low-powered credit and low-powered money. And mid-powered capital, like the S&P, it creates mid-powered credit and, in theory, mid-powered money if you could do it, but no one in the world has been able to do it. And the regulatory constraints, again, of the SEC Act of 1940 prohibit a large public company from doing this. Yeah, Stretch transforms a 40 vol, 40 ARR capital asset, Bitcoin, which is a commodity, into something that's more like a 2 volatility, 11% yielding, cash flowing credit instrument. So it's a gateway security. It takes the raw monetary energy of a commodity that's volatile and long duration without cash flows, and it makes it non-volatile, short duration with cash flows. And we think of it as like the layer two. That Bitcoin is digital capital for capital investors. You could hold it for a decade. And if you have a decade and you have a long, a low time preference, you don't need the money now, then you hold the capital. Stretch is a short duration credit instrument. So if you need the money back without the volatility over the next 12 weeks or 12 months or 12 days, then it's a stepping stone. And from Stretch, we see the possibility to create zero volatility, 8% yielding money. And so if you think about the mythical Bitcoin-backed stablecoin that pays you 8%, right? Well, Stretch is not quite that because it's got the 2 vol, but it's the intermediate step, and we see the exciting formation of a 3-layer monetary architecture: capital, that's 40 vol, 40 ARR, credit, which is 2 vol, 11% yielding, and then money, that's 0 vol, medium exchange, a unit account, a store of value. You can use it instead of a stable coin, instead of whatever. But as long as you're holding it, it's outperforming the monetary debasement rate or the inflation rate. And so all 3 of those would be assets that would be useful to the world in different contexts. And we think that will result in an overall growth of the Bitcoin ecosystem. We've had extraordinary success with retail investors.
Okay.
Retirees, any ordinary person that needs money to pay their mortgage, that needs to pay their taxes in 6 months, that needs to put their kids through college. They've got money sitting in a money market. They're afraid to invest it in the stock market because the stock market volatility is 15 or 20. Mm-hmm. They might be down 10% in 6 months when they need the money back, and that feels awful to lose 10% of your family's capital.
Yeah,
right?
Definitely.
So retail investors have been big buyers. Credit investors, Stretch has been incorporated into BlackRock's credit index, PFF, and into Van Eck's credit index, PGX. And it's like the number 3 holding in those credit indexes. Then you've got some equity investors. You've got traditional MSTR investors. And the other buyers now are crypto entrepreneurs, people that are developing savings coins and stable coin and yield protocols with stable coins. A lot of people want to generate yield on a stable coin, and then others want to generate yield on Bitcoin. And so STRC is a source of yield for either stable coins or Bitcoin. And of course, it works really well with stable coins because it's pegged to the dollar. And so if we've got something which is targeted at $100 and you're creating an asset which is targeted to trade at $1, then we've taken the 40 vol down to 2. So we've already taken 95, 96% of the volatility off the instrument. And then that leaves the entrepreneur or the people that are creating these digital money funds and digital money tokens and things. It leaves them to take that last step.
Yeah.
And that's much easier for them.
One of the most important ideas in this discussion is Saylor's explanation of how volatile Bitcoin can be transformed into relatively stable financial instruments. He describes STRC as a gateway security. According to him, Bitcoin itself is long-duration capital, highly volatile, and designed for investors with long-time horizons. But many people cannot tolerate volatility. They may need access to their money in weeks or months, not decades. That's where digital credit products come in. Saylor explains that STRC takes a highly volatile Bitcoin asset, which he describes as roughly 40 volatility, 40 ARR, and converts it into a much more stable income-producing instrument with only about 2 volatility while still generating approximately 11% yield. In his framework, Bitcoin becomes digital capital, STRC becomes digital credit, and eventually stablecoins become digital money. This creates what he calls a 3-layer monetary architecture.
Actually, I've been pleasantly surprised at how rapidly it's been embraced.
Okay.
I mean, it's the fastest growing credit instrument in the world. It's one of the fastest growing products in the world, and so it's not even 1 year old, and We've already got a groundswell of support. And, we were showing yesterday 350% annualized growth rate. So I think if you have a growth rate of north of 100%, you really don't have the right to complain about people not understanding your product. It doesn't surprise me that, traditional investors that haven't heard of it are surprised, because most investors haven't really invested in preferred stocks. Most investors don't really understand much about Bitcoin in general. If you walk down the street and you ask people, well, would you like a bank account that pays you 11%? The answer is universally, yeah, of course. What's the catch? And so a very healthy human response is, it sounds too good to be true. I have a robot that will do all your housework that'll cost you $100 a month and cook and clean for you. Would you like it? Yeah, sure, I'd like it, but what's the catch? The science fiction movies always have a catch where the robot gets smart and decides to steal your house or something.
Harvest you.
And if I say, I got a car that'll drive itself, would you like the car to drive itself? You can get in the car and sleep on your way to the destination. You're like, well, sure I would, but what's the catch? Well, is it always going to work? So if you have magic technology that's based upon AI or based upon digital assets or digital capital, the initial reaction of a healthy person is going to be, yeah, I want it, but let me just do my diligence. And that's totally fine. I think that's happening everywhere in the world at a high rate. It's like enriched uranium. You need a crypto reactor to create credit. So for every dollar of equity capital, of Bitcoin capital, you can create about 10 to 20 cents worth of digital credit. So if you have $100 billion worth of Bitcoin capital, you could create $10 to $20 billion worth of credit per year. You would need a public company. It would need to be exclusively invested in Bitcoin. So if a bank wanted to do this, they would need to create some structure that has $50 to $100 billion worth of Bitcoin held in one entity, and then they would have to go do an IPO and take a digital credit product public. If they were to do that, we would welcome that, because that would mean that another big company is buying $100 billion of Bitcoin, and I think that would be good for everybody in the Bitcoin space. If that were to happen, our Bitcoin price would go through the roof. We would end up inheriting another $50 or $100 billion worth of Bitcoin on our balance sheet in short order. Right?
Yeah.
So it's not a bad thing if they copy us. It's just unlikely that they will, because if you're a bank, your choice would be, I can invest $100 billion and create my own digital credit instrument like STRC, or I can offer digital money accounts to all of my customers to pay 8%, and I can power it with STRC, and I can keep 200 or 300 basis points of the money. So I could collect $100 billion or $1 trillion of other people's money. I could make $3 to $30 billion a year with no risk.
Right. Yeah, that makes sense.
And I could do it by partnering with Strategy and buying STRC, and I could do that starting tomorrow.
Right.
Or I can create my own crypto reactor, and I create my own. And I think, to be clear, there will be more digital credit. SATA is a very successful digital credit instrument offered by Strive. It's not as big as us. It won't have the same amount of liquidity, right? So we will simply provide the most liquid, most well-known digital credit. And if 10 other companies create other digital credit instruments, that's probably good for the ecosystem. And there are some people that will always want to diversify. They'll want 2 or 3. And there are traders that will want to trade in and out. They'll want to buy SATA, sell it, buy Stretch, sell it, etc. So I think it's good to do it. I just think that the real key here is, if you want to create the ideal credit instrument, you would like to sell $10 billion of it, and that means you need to back it with $50 billion of equity capital. And then, if people like it, you might get to $1 billion of liquidity, right? So you're trying to get to $1 billion of liquidity a day, 10, 20, 30 billion of AUM backed by $100, $200 billion worth of equity. It's a scale business, and we happen to be fortunate enough to have entered the business early and inadvertently created the scale, which now is a big competitive advantage for us.
Great.
Pretty market-driven and data-driven about how much STRC we issue. Right now, STRC has a BTC rating of 4. And that means for every $1 of stretch, we have $4 of Bitcoin. And that's a very comfortable collateral coverage. And based upon that, Stretch is trading very, very well. Over time, the question is, will the BTC rating go to 5 or 6, or will it go to 3.5 or 3? And I think that that's a function of what does the market expect. And if you go to our website, you can plug in your expectations of future BTC volatility and future BTC performance, or ARR. And if you're bullish on Bitcoin, then you would say, wow, having a BTC rating of 2 is more than enough. And if you're bearish, then you would say, well, I need a BTC rating of 10. I need to be 10x over collateralized. And of course, it's neither the bulls or the bears that will decide this. The people that will decide this will be the STRC shareholders. So every single minute of the day, we're watching to see, does STRC trade in the range, and how does it trade approaching the dividend record date, and how much demand there is. At some point, if it's overheated, there's a lot of demand, we might actually increase the equity capital of the company. Maybe we sell more equity and we buy more Bitcoin with equity to collateralize it more. And if it's under demand, if it's that's if it's under demanded. If it's over demanded, you would do the opposite, right?
Gotcha.
We're always adjusting, the collateral coverage and the capital structure of the company based upon the sentiment in the Bitcoin market, which is the capital market, the sentiment in the MSTR market, which is the equity capital market, and then the sentiment in the STRC market, which is the credit capital market. And it's a harmonious, delicate dance between the three, right? And they all have different moods,
Yes.
right? The credit investors are thinking different things than the capital investors, than the equity investors. And the key for us is we just want to do the right thing for Bitcoin, the right thing for MSTR, and the right thing for STRC.
Another key insight is Saylor's emphasis on scale. He explains that creating successful digital credit products requires massive Bitcoin reserves, deep liquidity, strong investor confidence, and substantial collateral backing. According to him, scale creates trust. Large pools of Bitcoin collateral increase confidence in the credit instrument's stability. This is why he believes early entrants with significant Bitcoin holdings possess major advantages.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.